Good morning everyone. I am Khushi Kumari from BCom Professional 4th Sem and today I am here to present a PowerPoint presentation of VAT. This is given by Vijay sir. What is VAT? VAT is a multi-point indirect tax levied on each stage of supply chain management. The consumer ultimately bears the cost of VAT while business collect and pay it to government. Features of VAT. There are 5 features of VAT. First one is multi-stage VAT. VAT is levied at each stage of supply chain management. The second one is tax on value added. VAT charged only on the value added at each stage, not the total price. The third one is input tax credit. Tax paid on purchase can be deducted from the tax on sale. The fourth one is eliminate cascading effect. It eliminates tax on tax, which was problem in the all tax system. It is destination based tax. VAT is collected by the state where the goods and services are consumed, not where they are produced. VAT in India. VAT is introduced in 2005 to replace the state sales tax. VAT is collected by the state government. In July 2017, VAT was replaced by the GST. But VAT is still applicable on alcohol for human consumption, petroleum product, some state specific items. Input tax credit ITC. ITC refers to the credit a business claim for the tax paid on purchase used in course of business. It ensures that the tax is only paid on the value added at each stage of supply chain management. Variant of VAT. First one is gross product variant, second one is income variant and third one is consumption variant. So I started with first gross product variant. In this system, VAT is only allowed on the raw materials. No input tax is allowed on capital goods. For example, a firm buy raw materials worth 1 lakh and machinery worth 50,000. He sells the finished goods of rupees 2 lakh, VAT rate is 10%. In this example, according to gross product variant, the VAT is only allowed on raw material. So that ITC is on 1 lakh at the rate 10%, that is 10,000. The second one is income variant. Under this system, ITC is only allowed on raw materials and depreciation of capital goods. For example, a firm buy raw materials worth 1 lakh, life and machinery worth 50,000. That life is 5 years. Machinery depreciate first year 10,000. Sale output worth rupees 2 lakh. VAT rate is 10%. In this question, according to income variant, the VAT is applicable on raw materials and depreciation of machinery. That is 1 lakh 10,000. So ITC is on 1 lakh 10,000 at the rate 10%. That is 11,000. The third one is consumption variant. Under this system, ITC is also on all business purposes including raw materials and capital goods. For example, a firm buy raw material worth 1 lakh and machinery worth 50,000. Sale output worth 2 lakh, VAT rate is 10%. According to consumption variant, the VAT is allowed, the ITC is allowed on the raw materials and capital goods both. So that 1,50,000 ITC will be allowed on 1,50,000 at the rate 10%, that is 15,000. That's all for today. Thank you.